Sometimes you might look around at your friends who have 401ks and pensions, and most of their retirement savings are taken care of through their work. But if you own your own business, there isn't an HR department to sit down with to set up your own savings plan. That's why you need to be aware of what your retirement saving vehicles are as a business owner. And if you want to learn more about financial planning for business owners, hit the subscribe button. Now, I'm going to split this into two groups. The first group is accounts that are tied directly to your business. We'll call those employer-sponsored plans. The second group is going to be accounts completely separated from your business. In fact, they may not be specific to business owners at all, but they might be just a good fit for anybody of relatively high net worth or high income who are looking for additional or alternative vehicles to save money in. We'll call these individual plans. So first, let's talk about investing tax buckets. You might be familiar with this from some other finance videos or my finance videos, but let's do a quick summary. There are taxable accounts where you put money into the account, there's no special tax treatment, and anytime that you have transactions in which you gain money, you're going to owe taxes on those. Then you have tax-deferred accounts, where any contributions you make are deducted from your taxable income that year, but you do have to pay taxes when you take money out in the future. Then there are Roth accounts, where your contributions are not tax deductible, but when you withdraw money from the account in retirement, it comes completely tax-free. Now, the reason these tax buckets are important is because depending on how much money you're making in any given year, it might be useful to switch between tax-deferred or Roth accounts. We'll talk about this more later, but here's a quick summary why. If your tax bracket and tax rates were the exact same between now when you put money in and when you withdraw it in the future, it would make no difference whether you put money into a tax-deferred account or Roth account. Let's look at an example. Let's say that I got paid $1,000 and wanted to put it into a retirement account. If I put it into a tax-deferred account, then I could put all $1,000 away into that account. Let's say that it then grows to $10,000. When I withdraw that money, I have to pay taxes on it. Let's just say for easy math, it's 10%. That means that I can withdraw $9,000 at the end of the day. I put in $1,000, I withdraw $10,000, but I have to pay a 10% tax of $1,000 and I have $9,000 left. But let's say I did the same thing but in a Roth account. Well, in that case, that $1,000 that I want to put away, I have to pay that 10% tax on the front end instead. So I get paid my $1,000, I pay my 10% tax, so I'm left with $900. If I were to put that $900 into a Roth account and it has the exact same rate of return that we talked about just a second ago, that means that I would end up with $9,000. And when I withdraw it, it comes out completely tax-free, so in both cases I end up with $9,000. The only difference is how much money I actually paid in taxes. In one case I paid $100 in taxes, in the other case I paid $1,000 in taxes, but mathematically it actually comes out to the exact same. I pay either $100 now or I pay $1,000 in future spending power. Most people don't understand that when they're looking at Roth accounts. They just look at one number bigger than other number, therefore small number good. And that's not necessarily true because there is a future buying power that you might be sacrificing. Now, in this equation, we're assuming that your tax rate is the exact same when you put money in versus when you take money out. But that's actually usually not the case. The theory is that most people will be in a lower tax bracket when they retire than they are now. If this is actually their peak earning years, then they should be in a higher tax bracket today than in the future when they have no mortgage, very little debt, and very little expenses because they have no family living at home other than their spouse. However, there are also many people who believe that tax rates in the future will be higher than they are today, and maybe justifiably so. Our country tends to have a little bit of a debt problem, so it's hard to imagine a scenario in which we don't raise taxes in the future in order to keep us solvent. We'll talk more about this later, but first, let's talk about some actual accounts. The first type of account is a SEP IRA. This is probably one of the most common out there for self-employed folks because it's one of the cheapest and easiest to set up. A SEP IRA allows you to contribute up to 25% of your net income or $70,000, whichever one is lower. All of the contributions actually come from your business, not yourself personally. And one of the reasons that can get tricky is when you bring on additional employees, they have to partake in that SEP IRA plan as well, which means that you have to be contributing on their behalf as your business no matter what. This account is also only tax deferred. There is no Roth version to contribute to, but like I said, it's cheap and it's easy to set up. Another option is a solo 401k. These are starting to become more popular because of technology. They've become cheaper and easier to administrate. In my opinion, these are ideal for solo business owners if they are eligible to contribute to one. The contribution limits are similar to a SEP IRA, except for it's 100% of your net income can go to a solo 401k or $70,000, whichever one is lower. So that does raise the amount that you can contribute significantly. They also allow for contributions both from yourself personally and your business. And they allow you to either contribute to a tax-deferred account or a Roth account. Here's why that might be helpful. Remember earlier when I said that a lot of people believe they'll be in a lower tax bracket when they retire? Well, here's a reason why that most certainly will not be the case. Most people get a job and make a consistent salary every single year up until they retire. There's very little fluctuation in their wages other than it constantly increasing due to promotions, cost of living raises, and things like that. They aren't usually fluctuating in and out of tax brackets every year. However, business owners have much more variable income. Some years you kill it, you do great. In other years, things are much slower. But neither thing should stop you from contributing to a retirement account. In fact, some of your lower earning years are the best times to contribute to Roth accounts. Because you're earning less, you're not paying as much in income taxes that year. Therefore, it makes sense to put money into a Roth account because you're paying the taxes up front when you might be in a lower tax bracket than when you retire. It's the same principle as buy low and sell high. Usually it's the reverse. You hold on to paying those taxes because in the future those taxes are going to cost you less. But if you're not earning as much in any given year, it makes sense to pay those taxes now because in the future those taxes might be a little bit higher. So something like a solo 401k, which has both a tax deferred option and a Roth option, can be a fantastic option for business owners as long as they are eligible to contribute. Next is a simple IRA. Now, a simple IRA is better if you actually have employees already on your payroll. Your business either has to match contributions from your employee up to 3% of their salary or contribute 2% on their behalf no matter what. Most businesses opt for the first because while 2% is technically lower than 3%, a lot of people will opt out of their contributions into a SEP IRA. While yes, in one scenario you might be contributing only 2% instead of 3% on behalf of every employee, you are contributing 2% for sure no matter what. While in the other scenario, some employees may just decide not to contribute, which would save you money in the long term. Again, this is a very easy and cheap plan to administer for small businesses, which is why it's pretty common for small businesses with 10 or fewer employees. However, if you're at the point where you're evaluating a simple plan, it may make sense to actually just get a normal 401k for all of your employees. Again, as you have employees, the amount of flexibility that you have personally to contribute to retirement plans does start to decrease. The business can't just put money into retirement accounts on your behalf like it could when you didn't have any employees, because now it has to treat everybody fairly. But there is one exception to this. Spouses. There are some provisions in solo plans for you to hire your spouse, and not only that, for them to have their own retirement account for themselves. Going back to a solo 401k, you can actually bring your spouse on and they can contribute to their own solo 401k without any sort of restrictions that you would have for bringing on other employees. Now let's move away from accounts that are specific to your business and let's talk about individual accounts. These can be helpful if you do have multiple employees and you don't have the flexibility with your business to dump money into retirement accounts there, but you do have the personal income that you do want to save more money than what you might be allowed to in just a regular IRA. Speaking of regular IRAs, let's start there. Contribution limits are pretty low, but they can be useful if you do have an established business and you have a retirement plan and you just want something filler. You can contribute to either a Roth IRA or a tax-deferred IRA. Another account is just a plain old taxable brokerage account. Now, this would be the first account we've talked about that would fall under that first tax bucket we talked about. These can actually be pretty useful because they have no contribution limits whatsoever. And not only that, no early penalties. And not only that, but if you cast a wide net in terms of your investments, you can actually harvest some of your investment losses to help alleviate your tax burden elsewhere. That's another subject that we're not going to get into today, but know that that can reduce your taxes not only now, but also years in the future. Now, here's one that may surprise you because I have spoken negatively about it before, but permanent life insurance can be a good tool to store capital. There are some unique features about permanent life insurance that you can't really replicate elsewhere. The first, and kind of the most obvious, is the life insurance part of it. A tax-free death benefit that's permanent and will go to your heirs is a pretty nice perk. But the loan provisions that come along with life insurance contracts can be useful if you wanted to invest in things outside of your business like real estate or even purchase other businesses. Because you're using your own money as collateral, the loan provisions in a life insurance policy are usually quite generous. And that money almost always comes tax-free because loans are not seen as income unless your policy doesn't meet the definition of a life insurance contract. Again, we're not going to get into that today. Again, this is not for everybody, but when you're looking at some of the benefits of permanent life insurance, it's hard to ignore as a decent place to save for the future and especially as a bond alternative. The last thing I'll mention is annuities. Annuities are particularly useful for business owners who receive a lump sum for the sale of their business. The entire idea behind an annuity is to convert large sums of money into guaranteed streams of income until somebody dies. They operate almost as a pension, and similar to the permanent life insurance, they can operate as a good bond replacement in a portfolio. If long-term financial security is something that you're looking for, annuities often tick a lot of the boxes that you want to check off. If you're a business owner and you're looking to create a financially strong retirement and overcome the unique hurdles that you have to go up against as a business owner, you can book a free intro meeting with me using the first link in my bio. And if you want to learn more about the 5 most common money mistakes that solo business owners make, you can watch this video.